In the decade leading up to the global financial crisis in 2008, the world had undergone a huge advance in technology, which was the main catalyst for the growth in the global banking industry. Because of tools like the World Wide Web, it became easier for all banks to complete transactions between parties that were large distances apart. Before the internet, these transactions were more costly and took longer. The growth in global banking saw the rise in large banks that operated both as international and domestic. Due to the large banks' borrowing sphere, the reliance from domestic banks increased massively. This created a web-like influence a big bank would have on other institutions, economies, and governments. One of these banks was Citigroup. This video is to argue in favour of why the government at the time needed to bail out Citigroup.
Bailing out a bank has a number of downsides. Not least, the moral has said that its expectation will generate having been used once. Other banks will expect that they will be bailed out and may hence be prepared to run greater risk. Another disadvantage would be that losses are placed on the taxpayer rather than on the creditors and investors who have knowingly taken risk in lending to the bank. Furthermore, Citigroup unlocked most of the potential losses from $306 billion of risky assets to taxpayers. Therefore, the rewards and risks are not symmetric. Where countries are heavily indebted already, such a bailout can lead to a financial crisis, as in the case of Ireland. The post-2008 Irish banking crisis bailout was the primary reason for the Irish government requiring International Monetary Fund assistance, and a total restructuring of the Irish government occurred as a result of this.
According to the too-big-to-fail hypothesis, failure of a large systematically important bank such as Citigroup poses a significant risk to other financial institutions and the financial system. Bailing out Citigroup relieved borrowing pressure on smaller banks, large businesses, and retail customers that borrow money from Citigroup by restoring liquidity. Without the bailout, many of Citigroup's borrowers would find it difficult to obtain cash in order to invest in activities that would develop the economy. Bailing out Citigroup enabled them to continue to lend to its customers and finance their operations. Liquidity injections into Citigroup also prevented another major bank failure by removing toxic assets from the balance sheet. Bailing out Citigroup gave depositors confidence that their deposits will be recovered, and it gave investors confidence to invest in major banks. The bailout prevented Citigroup from facing serious financial distress, and it helped mitigate the risk of bank runs and contagion of bank failures. Preventing another major bank failure also means that thousands of jobs will be saved.
Bailing out banks is a huge costly exercise, yet the cost of refraining is an even greater instability in the short term. According to the details of the first bailout, the government was given a stake in Citigroup in exchange for the bailout. In addition, Citigroup paid the government an insurance premium in exchange for an agreement that the government will cover the losses of its troubled assets if they fall by more than 10%. Jordan Goodman, a personal finance expert, said in an interview that because the market was losing confidence in the financial sector and the fact that Citigroup was too big to fail, if a large global institution like Citigroup were to fail, then it will take the rest of the financial system with it. He goes on to say that the government did not bail out Lehman, and this turned out to be bad, and if they had not bailed out Citigroup, it would have been worse. He also adds that even though $20 billion seems a lot, but the alternative would have been much worse for both the government and taxpayers if they did not bail out Citigroup. Therefore, the US government had to step in to save Citigroup by bailing them out.
As my classmates have argued, it was necessary that the US government needed to bail out Citigroup in 2008. The financial influence on not just the domestic but international financial community of this large bank could not be ignored. The result of the bailout meant that the US banking industry was able to survive the global financial crisis in 2008. However, the downsides to the bailout weren't ignored. In 2010, the US government proposed and put into law the Dodd-Frank Act. This was to ensure sufficient regulation on the bank's activities were put in place to prevent another potential bailout.